Check 1 2 1 2. Mic check.
Oh my goodness.
We're killing it. The Washington Commanders.
The Redskins?
Yes, thank you, thank you,
I'm happy that you're happy, buddy.
thank you. Oh, do we have a secret guest today? Throwing curveballs.
Somebody that's not been on yet, yes.
Can't wait to
Oh.
We even have a topic.
Is that a topic? Oh.
Oh, what's the topic?
Yeah. Man, I would have prepared something.
Jeez. The guy that's supposed to be on here presenting is like can't figure out Eastern and Central time.
So I think we should rename Eastern Time to Eagles Time and just.
Oh my gosh.
We'll all.
Hello and welcome to the Durham Talents channel. My name is Jesse Durham. For today's installation in our roundtable, we have a new roundtable guest. He's not new to the channel. His name's Brandon Bristow. You can see my interview with him on the channel to get an introduction on who he is and his experience with infinite banking. But he and Joe and Becca and I sit down and have a great conversation. We cover a fun topic, and I hope that you enjoy.
Yep.
Thanks for doing this, Jesse. I think it's awesome just to, have so many people be given a platform to just share their thoughts and their perspectives. And it's a lot. You did put a lot of work into this, and just want to tell you I appreciate it.
You're very welcome. It is my pleasure. It is work, and it's worthwhile work, and it's fun at the same time. Even if Joe is incorrigible with his Eagles language.
Hey man, you've been hitting me with that snowboard comment like clockwork every episode.
Right?
I got to get something back in there.
Yeah,
So good.
I feel the same way. It's and I mean, you guys have got a longer runway of experience than I do, so it's a blessing to me to be able to be sitting with you guys and having conversations like this, and so I appreciate that opportunity very much.
And we're stoked to have you here at a seat in the roundtable in particular. I've really enjoyed going back through our interview and then, texting and calling with you like I do with Becca and Joe in the meantime as well. So it's just a good fit, man. It's a good fit. We're happy to have you here at the round table. There's always opportunity for us to be able to talk shop, share best practices. I was just telling these guys before you jumped on about having a great conversation with 3 generations, family infinite banking phone call this morning before getting on with y'all. So good. Grandma, mom, kids, 3 generations. We're having a good conversation. They just seen infinite banking. So a great place for us to be able to talk about those types of things, anything from our personal lives, how we've implemented infinite banking, just all of it, right? Like that's the idea behind this round table. And you're definitely a good fit. I've really enjoyed our one-on-one conversations. So you have a particular topic that we're actually going to facilitate in this round table. So let me just turn it over to you. Awesome. Cool. So yeah, Brandon, welcome to the round table. This is actually a time where we have something that you and I know that we want to discuss. Becca and Joe don't know, which is just a lot of fun for me because I dangle it in front of them teasingly, toyingly, right? But also because it's a great chance and I'll go ahead and make this invite to y'all, just like I make to the audience. If you in the audience, you have topics that you want to see us discuss, put those down in the comments. We'll see that. We'll address it. But you guys, Joe and Becca, if y'all have topics that you'd like to discuss, I mean, we normally just do a lot of that anyway. But if you have something decidedly that you'd like to share, just let me know. But Brandon does show up with something for us today for sure. Why don't you take away?
Yeah, I appreciate it. So I will start by saying I was looking at a presentation that someone else had put together. It's actually Rachel Marshall with the Money Advantage. And it's in a space that I've been in since 2012, which is real estate investing. And so the idea was, what does it look like if you compare investing in a single family rental property through the traditional means, saving up some money. Usually it's for the down payment of the property, getting financing for the remainder, and then, putting it to work, compared to if you had that seed money already stored away in a what we call an IBC fashion. So you use a whole life contract and you use that cash value, and you take a loan from that cash value to then pay for the down payment or the property, to get into it that way. What would the difference be over the lifetime of a typical loan, which would be 30 years, right? And so I went back and looked at one of the properties that I purchased and did a remodel on. It was a really great acquisition for me from a return on my investment perspective. And I wanted to see what that would look like, and ran my own illustrations. I say illustrations because, I'm computing the math using financial calculators to try to come up with what the numbers look like in the projections, which, of course, as we know, is never going to be perfect. It's always going to be, changing because interest rates change and this and that. But at least it gives us an idea of what that would look like. And so that's what I wanted to share with you guys and get feedback on. So I will jump into it right now and pull up my slides on that. All right, so obviously here's the title that I just introduced to you guys. So here's the property. So the original purchase price was $115,000, which even back in 2017, when I was negotiating with the bank, is a low dollar amount. In fact, they had the property listed for somewhere around 145. And, I did my math and made an offer of like 110. They declined my offer. And then I noticed I went up a little bit and countered, and they declined my offer again. So I came back to them a month later, made the same offer. They rejected that offer again, and I offered like $500 more or something like that. And then the second go around, they actually accepted my offer. So that was a pretty fun little negotiating deal to get into the asset. So one of the number one rules in real estate is you make money when you buy, not when you sell. So it's about purchasing the property at the right price. So here's what the money looked like going in. So I used a hard money loan, which is basically a loan not on my credit worthiness, but on the asset itself. And that loan consisted of the purchase price, $13,000 of the repairs, and about $4,500 in costs of the loan, which was held for about 3 months. The total cost for repairs is $35,000. And so 22 of that came from my personal savings, 13 from the hard money loan. And then, that completed the total cost of that. So here's kind of,
could you go back one slide, and you can tell me if you're getting ready to cover this, but I'm curious, Brandon, about a couple things, or maybe talk through a couple things. And this is if you'll let me. I don't want to bog you down in your flow. And again, tell me if you're getting ready to talk about this. Number one, I want to say that's cool. Just a quick calculation on my phone shows me something like 79 cents on the dollar is what you got from what the bank evaluated the home at and what you're able to get it for. So that's just cool. So that's just neat, right? I love hearing examples, real life examples like that. And then I guess one of my questions would be the 13,000 in repairs and then the 22 from your savings. Was that planned, or did you think out of the gate, no, the 13,000 is what I need to make the repairs that I want? And then you found out, no, it's actually going to take some more, and then you put some of your own money into it. I'm just curious.
No, I I knew that the costs were going to be at least 25, if not more. And so the way the mechanics work with a hard money loan is they have to actually come and do a check on the progress. And when they see that the progress is done, then they'll release the funds. And so since I actually had the money available in savings, instead of going through the hassle of that and slowing down the process and waiting on them to do that, I just started funding a lot of it out of pocket just to keep everything moving.
Neat.
So, yeah.
So I just want to ask those types of questions. Number one, because I'm curious, right? And I love hearing about this example. Number two, because some people are in this space and they would maybe already be curious about those extra details. And then number three, for people that aren't in this space, I mean, I just know that we end up talking with a lot of people that have their minds on investing in real estate and whatnot. When we're talking to them about infinite banking, right? And those are two distinct categories, right?
Mhm.
Investing versus banking, two distinct categories, not the same. Um, and yet they might be trying to educate themselves on real estate investing and how it does, play into infinite banking if you're doing that. So last question on this page, if you'll allow me, how did you estimate? Because, and what I'm trying to point out here is that you have experience in this field. Like, so that's kind of a caution to people, right? Again, I think you should be doing investments where you have experience, where you have connections, where you have gifts, where you know what I'm saying? And there you were with capital to be able to do things also. So how did you just come up with that ballpark of, I think this property is going to take 25,000 to fix up the way I want?
Yeah, so I am not a person that likes to just kind of guess at stuff. And so I bring crews in and I have them look at everything and I tell them exactly what I want to do. So I feel I complete kind of my own bidding process before I go into something like this. So I have a really, really good idea. Of course, there's unknowns that come up, like actually in this house when we started ripping down some of the sheetrock and stuff. It actually had water damage in it, so we had part of the sheetrock was ripped out already, and so we did some more stuff, opened up a wall, and discovered there was actually termites in the house. So that sounds really scary, and people make it maybe bigger deal than it really is. But it actually just meant that a couple of walls needed new 2x4s, which really, in the grand scheme of things, isn't that big of a deal. And then, of course, we treated the whole house and everything around it for the termites to prevent it from happening again.
Right. And again, that's why I say we're not giving investment advice here. We're friends sitting down having a conversation about something that our buddy Brandon did, but it's great conversation to have. And you're right. I would say this prefacing comment, and then I'm going to turn it over to Joe if you'll let him. He's been more polite and he's actually put his hand up on the Zoom call here. Whereas I just jumped in and interrupted you. I just commandeered your presentation. But typically, I don't care if it's business or investments or whatever. It's just a good mindset to think this is going to cost more than I think it's going to cost, and it'll probably take longer than my initial time frame that I think it will. Like if you just start from there and then it goes smoother, great, right? But if you have that mindset out of the gate, then maybe that'll be helpful.
Completely fair. Yeah. What's up, Joe?
Man, so many good nuggets there. I just wanted to highlight a couple things for Jesse's viewers. You share. Thank you for sharing the mechanics of hard money lending. I don't know how many people are familiar. I'm not intimately familiar, but to hear that's really cool. Some things that you might want to keep in the back of your mind as Brandon goes through his presentation is, you said hard money lending is based on the asset and it wasn't based on your credit worthiness. So to keep that nugget in the back of your mind, that's really powerful. Um, the other thing, maybe kind of a negative, which Brendan, you had capital already stored up, was that in order to get the funds released, you had to play by their rules. They had to come and check progress. They had to verify things were done to their specifications and so on and so forth before they gave him the money. So although you kind of got around the credit worthiness thing. You didn't have to verify there. You're playing by their rules because it was their capital. Just something for the viewers to kind of keep in the back of the mind. Um, the other piece that Jesse just hit on, man, everything I just said, everything costs more and takes longer than you think. So for people that are like projecting things way out into the future in this idealistic kind of way, this static growth kind of way, life doesn't go that way. like life isn't a straight 45-degree angle. It doesn't exist in nature. So just something to be aware of. And one last bullet point, Jesse said banking is different than or maybe Brendan, one of you said banking is different than investing. And I think like if we back up for a second, you must bank to invest, right? Banking is the storing up of capital and the movement of capital. If you don't store up capital or move it, you can't invest. So it's the natural order is to bank first, invest second. So just my opinion, just throwing it out there. Yeah, please keep going, keep going. This is great.
Yeah, that's good. And I mean, you need a buffer, right? Like if all I had saved up would have been $25,000, and then it cost me another five or ten, then I would have been in a bad spot, right? Or would have had to find additional funding somewhere. So very good. All right. Um, yeah. So sometimes when you buy amazing things like properties that have been older or run down or whatever, you get some pretty cool colors. So I thought this picture kind of showed that. But again, the repairs, the hard money loan, and actually, so Jesse, the bank had priced it at 145, but once it was all that was as is. That was kind of their opinion of the value as is, and the actual market value once I got it repaired was 175. Even putting that amount of money in, total all in would have been around 150. I still had some equity built in right there out of the gate. So I got permanent financing once the repairs were done. Because another thing, and you'll see this in the next picture, another picture before rehab, is you could not get a conventional loan on this property because of the condition it was in. And there was, walls ripped out, the floor was really messed up. The toilet was pulled off of the floor and sitting in the bathtub. So it was not livable, and so you cannot get a traditional loan, traditional financing with a house that's in that condition. A bank just won't loan money on that. And it's often these are the deals that, or these are the properties that make the most sense and become the best investment.
If I could jump in then here real quick. Okay, you just added one more thing. So again, this is not investment advice. I'm just talking to Brandon, but this is where people with, again, the background, the experience, the connections, and the spine, right? I mean, like, and when I say that, people have different levels of temperance when it comes to investing, right? Investing. I am talking about investing there. But when you see something that is uglier, typically there's more meat on the bone, so to speak, there, right? There's, right. So there's something to be said about that. But what I was going to ask too, though, was if you would just run through these abbreviations that you have on here, the ARV, the LTV, just one more time.
Yeah. So ARV is the after repair value. So if I purchase for 115 and I put $35,000 worth of repairs, once it was all fixed up, it was worth $175,000 after an actual appraiser came to the property and looked at everything. And then the LTV is basically 75% of loan to value. So if it's worth 175, my loan ended up being 131. And if the amount to pay off the hard money loan and up to that 75%, whatever that difference is, that left me with some closing costs as well as any delta in the equity in the property to be able to put in the property for the bank to give me the loan for permanent financing. So final out-of-pocket costs ended up being 28,700, which is kind of cool because you think okay, cost 115, cost 35, but because of the actual increased appraised value, not all of that money ended up being money that stayed out of my pocket. So $35,000 that would have been out of my pocket wasn't completely out of my pocket, right? So only about $6,700 of it was. So does that make sense to you guys? I added enough value that I could get enough loan from the bank to cover a portion of that repair cost.
That right there, that sentence right there, I think sums it up for people who maybe haven't gotten in here on any of this yet. So maybe hit that home one more time.
Yeah. So if there's So whatever that math is, so 150 all in, and loan was 131. So there was $35,000 worth of repairs with closing costs. But so the value of the property was pushed up so much that the 75% loan to value gave me a loan of 131. And so even though it cost 35K to repair it, with the closing costs and the actual forced appreciation by the repairs, the value of the home to get to that 131 number, it was a little bit less. So 6,700. I think about 3,000 of the 6,700 was actually fees and closing costs, and so the rest of it would have been the remaining amount of dollars I needed to put into the property itself. That I was showing the bank that I had money invested in the property to have enough equity in the home, 25% in this case, for them to make me the loan. So that's why it only really cost me $28,700 out of pocket.
Right. So because of the risk that you assumed, because of this venture that you took upon yourself, where you are using your skills and your connections and the crew people that you know and all that kind of stuff, because you took that upon yourself, you were able to add so much value to this deal in making this rehab that the numbers worked out. And I can't wait to hear you talk more about it. Joe's got his hand up again. So nice, so polite.
I'm loving this. This is such a good example. I think it's funny that Brendan thought he was going to be done in 15, 20 minutes. We're on slide 2.
You're right. I should have thought more about who I'm talking to here.
Man, so just that nugget I mentioned in the last slide, just let's append that a little bit. Let's add a little bit to that. So we got the hard money that's based on the asset, not Brendan's creditworthiness, but strings attached. There's, they come and check and make sure everything's up to spec before they'll give Brendan the funds. Why did he have to go that? Because this is another piece of this. The traditional banks, the traditional financing, conventional financing, the constraints for them to give you funds are much tighter, which leaves a lot of the opportunities like outside of the people that only have that source of financing, because they will not lend on that asset or the asset plus your credit worthiness. Even that combination is not good enough for the risk Jesse was just talking about. Man, that's so good. The other piece, like another thing to keep in your mind, Brandon's talking about the ARV that forced appraised the forced appreciation of the asset, the forced increase. Keep that idea that this asset can be based on his behavior, the asset increased significantly over time. So with this, I forget how long, maybe he said 3 months or so, he was able to, by his behavior and his relationships and the contractors he knew, created this value that forced the appreciation of his asset, which allowed him to now go back to that traditional bank and say, hey, I'd like to work with you now. Now I fall within that the lane that you guys are comfortable with. Can you give me money? And they were willing to do it. So cool. Keep going. Keep going.
Yeah, because the hard money loan is actually expensive. So you're paying like 12% and then like a point at the end or something to that effect, right? So I mean, it costs $4,500 for me to borrow $132,000 for 3 months, right? And then of course conventional financing. I think my original interest rate was like 4.8% on this property back in 2018.
Can I say one thing here, because I'm inspired by Joe, to point out, I smell what you're cooking, buddy. Talking about that value that Brandon's behavior caused to increase. What would make a bank hold you at arm's length, turn their nose up to you, is exactly what a fellow like Brandon can go out there and make happen, and it be beautiful for everybody involved. It's beautiful for him. It's beautiful for everybody that was called in to do their labor or their part of fixing that job. It's beautiful for whoever rents that place, buys that place next. Like, it's a win-win-win situation all the way around. And it's something that a bank is going to hold you at arm's length. No, you don't qualify. No, they're going to turn their nose up to you, right? I'm just saying, like, this kind of stuff right here is what gets me fired up. And I know Brandon's going there about infinite banking because that independence, that control, that behavior, right, that you can funnel towards profitability. So cool. So amazing.
Yeah. Joe, you're up.
Yeah, so just piggybacking off that, like the bank is so like laser focused on the as is or the current or today's value. It's the same dang property, but they have zero imagination. So they're looking at it today and they're just like, no thanks. We're not in. Go find money somewhere else. Brandon, being the entrepreneur, worked with them and like they had the asset. I imagine somebody had the asset. Maybe it was distressed. Maybe it was already bank owned, but he was able to, right? The bank had it and they're like, this thing isn't worth the land. It's trying to sell it for what they could. Brandon negotiated it down. They wouldn't give him financing on the lower than the value they were asking. They still wouldn't give him financing. He had to go to this other hard money lender to do all this wonderful stuff
Right.
and then turn around and sold it, basically sold it back to them.
Right.
I love it.
Yeah. Yeah. Took it off their books, right? Helped them out too, right? As Jesse was saying, all the people that benefited, the bank that owned it benefited because they didn't have a problem property anymore on their books. Um, yeah. So now fast forward, 8 years or so, and the current asset value is $275,000. And I'll walk through kind of what the history's been with that over this time. But here's another beautiful picture. This is where we found the termites. Actually, on the far right-hand side of the screen, you can't really tell from the way that picture's cropped, but it's kind of like made this narrow opening. That's from the kitchen into the dining room. And so it was a blessing in disguise, right? So I took that wall out and made it completely open, and it made it nicer. So a plus for even the termites helping me out on that. So 2017, again, the purchase price, the remodel, total out-of-pocket costs. So OOP, my acronyms there. And then in 2020, I was in a situation which we're all familiar with, where the rates were just extremely low, forced lower probably than they should have been. But at that time, it was a benefit for guys like me that were owning real estate, where you could take advantage of a lower interest rate and actually get some of the equity out of the property and put it to work somewhere else. So I was able to do that in 2020 while keeping the cash flow basically the same. So the payment was basically the same once I refinanced and pulled that money out. And then from 2017 to mid 2022, it was a long-term rental property, and then in 2022 turned it into a short-term rental property, and that increased cash flows even more. There's the beautiful toilet in the master bathtub.
It's efficient, man.
Yeah. So here's some expenses, right? Because it's not all just green fields and roses, but there was a water leak in 2022, and you're like, how the heck can a water leak cost $6,000? Well, it was underneath the foundation, so we had to tunnel underneath the foundation and fix that, and then a new AC in 2023, and so taking my history. The average cost of repairs was $2,000. So I put that there so that we can, I'm not presenting this, hopefully, an unrealistic view, but there are costs, right, that are ongoing. And I've done my best to account for what that might look like moving forward as well, based on what the history has been.
Brandon, I just like to say real quick, I really appreciate that because in the past, when I've seen these types of comparisons, it's like, hey, this is what I bought the property for. This is what I sold it for. It's all, I made this incredible return, but it's those like real life things that come up. Like there is a cost to managing and the upkeep and the repairs of these rental properties. And a lot of times I think that gets overlooked. So thanks for factoring that in.
Yeah, 100%. I mean, it's not easy work, but it's not hard work. I think a lot of times people go into this type of business and they hear all these stories and they think they have a rosy picture of what it's like. But if you're at work, any job you're doing, there's going to be challenges, there's going to be problems. And so I've always just kind of had to, my wife was one that was like, her family had rental properties. She didn't want to get into it because of all the nightmare stories that she heard. And I'm like, look, we just have to go in it knowing, yeah, there's going to be issues. I mean, we just handle the issues when they come up, right? And so it's also just a mindset. So there's people are afraid to take a risk in something like this because of preconceived ideas or just the perceptions or the thoughts they have around what it looks like when someone calls you and says the toilet won't flush or whatever, right? Just take a deep breath. It's going to be okay. It's just like any other job on the planet. Sometimes things don't go the way you want them to, and you just got to address it. So, um, anyway, just a
Brandon,
little extra philosophy there for you.
the philosophy, can you say the first piece again about the mindset? Because I think it's another good nugget for people to keep in the back of
Yeah.
their mind.
Yeah. Just the mindset that anticipate problems, right? Anticipate calls at night or texts at night where the tenant is upset because something's not working right, and just go, hey, this is actually kind of a customer service position that I'm put myself in. And my goal is to say, I'm really sorry that you're dealing with that, but tell me what the biggest issues are. Are you able to make it through the evening? Can I get someone out there the next day? You just troubleshoot it, right? And just have people lined up and ready to go. But the point is, just know what's going to happen. And if you tell yourself things are going to happen, then you're not going to be like really upset when they actually do happen, right? Or really shocked, which we shouldn't be anyways. But it seems like some people have that mindset, and so they're completely shut off to maybe taking some of these opportunities, what they perceive as risks, and making them opportunities.
I think staying between those two gutters of being so fearful, like unwarrantedly so, right? Or just being too, like you said, green pastures, roses, nothing but butterflies. Those two gutters, staying between those is going to be helpful mindset wise. And I'll tell you what just occurred to me. The four things that Nelson mentions that are requisite for somebody to consider becoming their own banker, I think they apply to this right here. You came in with some imagination on this opportunity. You're certainly reasonable and logical and, like you said, lining up people, estimating this, doing all that kind of stuff, right? And then prophecy, I think that could even apply because you've already run those numbers by us. You probably suppose that the value would continue to go up, not just because of what you would directly do to enhance the property, but because of what real estate does or that area does, right? So I just think that's very helpful as well, that all those four things, right? Being imaginative, using reason and logic and prophecy, all that happens between our ears, And when I see an example like this, Brandon, it's a way to address what you said about what you put into it. It's a way to not just have yourself at work, but you're also now putting money to work as well, right? So it's work. It has its challenges, like you said, but it's not the same thing as digging a ditch either. And I'm not saying that we got to have ditches dug, but what I'm saying is that this is a way for those that have interest to be able to put themselves to work in a certain capacity, right? And put money to work as well too, though, which is going to lead to these kinds of numbers in a different way than, say, just pursuing a W-2 salary would. All right, I'm ready to see this.
All right, cash flow. So I always went into a property or a project based off of, can I get at least $500 a month cash flow? And so that's what I was able to do up until, like I said a while ago, the mid 2022. So there's kind of the cash flow for that time period. And then after that time period, it's averaged about $1,250 a month, turning it from a long term to short term. And so this is where I take my basis, right? And so let's say that I had that money that I originally put in and I put it into a policy and I gave it a 4% and you guys, as you know, currently the dividends and interest that are being paid on a whole life insurance contract is higher than 4%. I think we're at 5.75% right now. And so it depends on the insurance company, but that's where I think Lafayette Life is right now. And then, so we look at year one, and as we know, that there's a cost to setting up a policy, right? So you're capitalizing your business, you're starting a new business, and you expect there to be a cost in the beginning. So that cost is reflected here. So obviously, to get to that 27 or $28,000, you would have to have either funded it for several years or had put in a larger amount, let's say $50,000 to $55,000, to be able to access enough to take a policy loan to be able to get the $28,700 that I used as my cash out of pocket to be my quote unquote down payment, which you saw was partial repairs, and then ultimately became the down payment once I was in permanent financing. At a 3-year point, that same amount is 26, almost 27,000. Year 6, now we're above that amount, and year 8, 32. So I did 8 years just because that's basically where I'm at right now in the life of my ownership with this property.
All right,
All right.
before you move on from that, again, tell me if you're getting ready to cover this or whatever. But I want a simple in that prior layout of the years, year 1, year 8, all that stuff. If you can go back to that,
Yeah.
could you give me the 1-sentence, 2-sentence version of what you just said to make sure that I'm clear and tracking on you? I understood what you said in the beginning of if somebody has $28,700 in a checking account, in a savings account, in a money market account under their mattress, and they wanted to go out and make a down payment on a house, they could do that, of course. But that way of doing things means that they liquidate those funds. They don't longer have any longer have them, but they get to do the deal, right? Also, they could finance that on somebody else's terms and conditions if they qualify, pay them interest for that $28,000 to be able to get the down payment, to be able to go out and get the deal, and that has its natural repercussions of conventional finance as well. But what is it that you're laying out here then? Year 1, 2, 3, 6, 8, that you're pointing the viewer to, saying, well, if you use IBC, if you're your own banker in this scenario, connect those dots for me. I hope I asked that well.
Okay, good. Yeah, thanks for asking me to clarify, because it can be easy to miss. So basically, my point here is I'm putting money into a whole life insurance contract, which is providing a death benefit on my life or whoever is insured through that contract, right? But also there's living benefits in the way of cash value that afford me the ability to take a policy loan against that cash value from the insurance company's pool of money and put it to work to either buy assets like this or even finance vehicles, but in this case to buy an asset. So I wanted to say let's look at what that actual basis, just the $28,700, would look like year 1, 3, 6, and 8, and then I look at it further on down the road as we get through the slides here. But I wanted to see what would that basis look like in a whole life contract versus, like you said, taking it out of my savings, which, by the way, is now out of my financial ecosystem forever. But with a whole life insurance contract, it actually stays within my control, my financial ecosystem, for the rest of my life if I'm the person that's insured, right? So that's going to grow now, compounding for the rest of my life. And I put 4% as the number. And as I stated earlier, that's actually a very conservative number, especially for today's rates. And so originally, when you fund a policy, there's some startup costs to getting the policy set up. And so that's what year 1, why it shows that it's lower than that 28,007 $700, and then it kind of climbs over time until about year 5 or 6, where it's actually now greater. And then from that point on, it's just going to continue to get greater. This is just the $28,700. Now, I would have had to fund the policy for longer period of time, or put more money in than what I needed access to be able to pull that amount of money out, let's say in year 1. But that's what it would basically look like, and that's what it's doing. So I'm just showing people that this is now going to grow, compounding at interest and dividends for the rest of my life. Yeah, Joe.
Yeah, I just wanted to like I love that last piece that you said. You said it twice now. The right answer here is pay longer or pay more. Like he used the example, maybe 50,000 to have access to the approximately 30,000, or have already paid for 1, 2, 3, 4, 5 years to have access to the 28.7 that he needs.
Right.
Right. There is a third option that if you're not thinking long range and not really trying to implement this for long term, that you're able to do something in the short term, very short term, but it inhibits the future. And a lot of people lose track of that future costs, what they trade to get the early access. Um, yeah, I think that's so I love that for pay longer or pay more to get what you want. Don't cheat yourself and try and pay as little as short to get what you want.
Right.
Right. I appreciate it as well that you repeated that same phrase that I caught on to twice. I think that's the hinge of this page, that capital must reside somewhere. And if you incorporate infinite banking alongside of this deal and you're becoming your own banker and you decide to build capital at $28,700 a year, you're going to see this constant upward growth trend year over year of the pool of capital that you have access to leverage for stuff like real estate. So it's not just being liquidated as if you were paying cash for the thing, and you're not playing by other people's terms and conditions and paying them interest. If you're doing conventional financing, you're adding that one step of funding a policy first at 28,000 and change, and then you see a bit of illiquidity in the beginning, but that grows and compounds over time, and you end up with a greater access to capital, guaranteed, by the way, guaranteed for the rest of your life for stuff like this. Does that clear us up on this page? Thanks for spending the extra time here, Brandon. I think that's helpful for me and therefore going to be helpful for everybody else. But what you said right there about if you want access to a couple of tens of thousands of dollars for a deal in year 1, then you must pay extra. You need to put in more capital than that amount that you want to have access to, because you're just getting started with the policy. Or if you don't need to do this in year 1 or don't want to do this in year 1, but you got your eye on a 3-year goal, a 5-year goal, a 2-year goal, like whatever, then okay, you'll be capitalizing over those years until you're ready to pull the trigger on what it is that you want to do. Is that a fair reassessment?
Yeah, absolutely. Yeah, I love it because this is not showing anything that is like get rich quick. It's easy. It's like gangbusters making a bunch of money, but it's like the old slow and steady wins the race, thinking long term, like Nelson would say, and really planning things out and being patient. Go ahead, Joe. Joe.
Right. And it's in conjunction with what you're doing in real estate. Like this right here, what we're talking about is just the banking aspect right now, just you building up capital, banking
Right.
capital. But then what you could do with it, that could be, very profitable, sure.
Go ahead, Joe.
Yeah, so I just wanted some people probably sitting there trying to crunch the numbers on the video, and they're like, well, wait a minute. 24,870 at 4% for 8 years should be 34,000, or 28,700 at 4% for 8 years should be like 39,000, 40,000, something like that. And I just the rates in this, it's an increasing increase, like if that makes sense. That's how a insurance contract grows, quote unquote, over time. It's an increasingly increasing rate, or increasingly increasing volume is a better way to put it. So the, we're so accustomed to think rates are static and stay the same through the whole time period. Remember what we said in the beginning here. Nothing just goes up and to the right at a 45-degree angle in real life. Just like costs, the cost conversation we were just talking about. Everything costs more and takes longer than you expect. Like he did a great job highlighting the idea that Brendan did a great job saying it's like you're starting a business, just like you bought this property. You started in the hole. When you start a business, you start in the hole. You got to take account of all those costs. That's why if you're plugging in your future value on your Excel spreadsheet, it doesn't line up to the penny. Well, this is more real life than the Excel spreadsheet. Life doesn't fit on a spreadsheet. But yeah, please keep going. Oh,
Brandon, are you regretting giving us permission to jump in on each slide and each line yet?
yeah.
Are you regretting not prefacing by saying, now, guys, let me run through this thing and then we'll take questions at the end?
Well, I'm not going to say that out loud in front of everybody. In the back of my mind, yeah, absolutely. um, no, that's good, Joe. What you pointed out, like, because yeah, like if you haven't seen the mechanics like of a contract with a whole life insurance, so after the end of 1 year, you pay your premium, a deposit of your dividend is added to your cash value, right? And so that's the compounding. So let's say it's $3,000 after the first year, and then the next year it's 4,000, and it's just slowly starts climbing because the basis that's in there, which includes part of that dividend, is now compounding along with your original basis, and that's what makes this such a powerful tool to be able to use for your own banking. All right, here we go. So I do need to point out, and I kind of said it a while ago, that this is not taking account additional premium dollars that would be being paid into a policy. This is just taking into account the money that I needed to use to purchase the real estate and have the down payment for that. So here's the value of that same 28,000 at 10 years, at 20 years, and at 30 years. Just the $28,700, right? Only the basis. If you never added anything else to it except for the dividends that are being credited, that's what that number would turn into in 30 years. All right, so now additional cash flow goes towards premium. So after 68 months, the cash flow that was coming in from the property itself is going back to pay off the loan of the $28,700. After 68 months, it's paid off. And then from that point forward, we now start applying that cash flow to more premium in the policy. And the 30-year value with adding that cash flow is $623,647.
All right. So if I jumped in right here,
Yep.
the prior page that you just showed was saying, okay, the 28,000 one time, if it grew at 4%, it's going to be a bigger number. And then on that page that we were just on, you're saying, well, if the property's paid off in about 5.5 years, so like 5.6 years, if the property's paid off in 5.5 years,
Okay.
yeah,
Not the property, the down
Policy.
payment, or my money out of my pocket, which was the 28,700, is paid off. That's in this scenario that I'm depicting right now. I'm only taking a policy loan for the out-of-pocket costs, and I'm still using a traditional bank for the other 75% cost of the property.
thanks for clarifying, cutting me off and not letting me keep going saying the wrong word. Right. just the down payment, then that frees up cash flow because, again, capital must reside somewhere, right? And we all experience cash flows. And anytime that you can direct it from something conventional to the policy instead, then it completely changes your results with that asset, that private banking system in the future, which is what you were showing, right? That part is fair. Like any new dollars that you can now direct towards the policy increases your death benefit, increases your cash value, and increases the dividends that you'll be able to earn because you redirected that cash flow to the policy.
Right. Exactly. Go ahead, Joe.
Yeah. I was just I was just thinking the contract is increasing. Actually, you know what? Never mind. Never mind. Keep going. Keep going. Keep
Okay.
going.
All right.
Whoops.
Cool. All right.
Actually,
So,
sorry. I want to clarify for the audience. I'm sorry. I'm
yeah,
sorry.
yeah, no, this is good. Good. Don't apologize.
Like if you're the comparison in your mind might have been, oh man, if I put my cash in my savings and earning 4%, the number be bigger than the number in the cash value on this year or that year or what have you. That's not what Brendan's saying. Brendan's saying he could have spent out of his cash and the money's gone. You traded the money in your savings account for the property. Or you could have had it in your policy, like it's you've paid it as premium. It's been the cash is converted to premium, a superior form of capital within the contract, and it's appreciating forever. He gets that, plus he gets to borrow and go get the property. So it's whether that I forget what slide, but it had like 90 or 70 or $80,000 a year, what have you. That's more than zero that you would have had by doing it through the savings account method.
Right.
So whatever it is, you win.
Right.
You that gets added to like all the cool numbers and rates of returns. It would have enhanced it, several fold if we added that in. Sorry, sorry. I just wanted
No,
to make sure
no,
that the comparison is clear for people. We're not saying we're comparing this to a bond or comparing it to it's he could have bought the asset or could have done this and then bought the asset, which was better.
yeah, no, that was good. That was a good recap. And with all that extra money, you could probably buy everybody in the household a snowboard to put in the house too, couldn't you?
That's a great idea. I wonder where that came from. All right. So total cash flow.
I made him mad. He left. I made him mad. I made Joe mad. He left.
Boy. Um, Total cash flow in 8 years, $71,250. Asset appreciation is $160,000. So again, I purchased it at 115. I put a little bit of money in it, and the current value is 275. And so the equity, current equity, and this is not teased out here, but after the refinance and the current equity and the amount I owe on the loan is $129,000. The total gain without IBC currently would be $200,000 minus $16,000 for expenses, which leaves me at $184,000 if I were to sell the property. So that includes the cash flow and the equity minus the expenses. So total gain in 8 years with the infinite banking concept would be $217,000 after expenses. So again, it's only 8 years, but you can see the difference and then all the benefits that we've already discussed, or a lot of the benefits that we've already discussed with the living benefits of a whole life insurance contract and the cash value that's available.
You inspire me, Jesse, with your just like, okay, we'll just make it work, whatever we need to do. But no big deal.
All right, so for everybody that's tuning in, we had to pivot with the technical stuff, but we're back on Brandon's slideshow. We're having such good conversation. I can't even wait for you to see. Actually, I'll mention this. I normally put some extras at the end of the regular podcast. Make sure to tune in for those. All right, Brandon, back to you.
All right,
I did not know that.
Yeah, I think we covered this. Unless you guys had any more questions on this bit of information.
I wouldn't say questions, but I loved what Joe said when he was recapping this slide and prior slides, that by adding the step of becoming your own banker in any scenario, it's bigger, better, more profitable. You have control. It just adds more to what, like Brandon, you're a guy in Texas who knows things, knows people, can look at something, make something happen. That's just where you're at in life. And everybody has their gifts and abilities and their skills and their connections, right? And they have something to bring to the world. But if you're the banker in this scenario, it's just better. So I liked what he said, and I just underline that before you move on.
Yeah, and maybe that $17,000 doesn't look like an amazing difference between $184,000, but you think about even in the beginning when I was just paying back that policy loan with cash flow, like every single month, $500 goes down and pays, some of that money. And what happens 2 weeks after that $500 goes back in, that $500 is available if I needed it, right? So you multiply that over an 8-year period, you have access again to all of that capital to be able to use for whatever. And again, it's getting dividends on top of it and interest on top of it that's compounding year after year.
Correct. As you're building up that capital that you have access to, again, your gifts haven't gone away, your experience hasn't gone away. You could do more of what it is that you want to do. Absolutely.
Right. All right. So again, total cash flow at now 30 years, 71,250 from the previous, and then for the 22 years thereafter is $290,000, which is a grand total of 361. The asset appreciation from that period to now, or to that point in 30 years, is projected to be $532,000, which is around a 2 to 3% appreciation, which is kind of the typical market appreciation. Not like the crazy 14% that we've seen the past few years, by the way. Equity would then, the loan would be paid off, so the whole thing is worth 532. So that's the equity in the house. So total gain without the infinite banking concept is 833,000 after 2,000 of expenses are factored in for each year. Now let's look at it with IBC. So again, total cash flow, equity, gain without IBC, cash value in 30 years, 624. Total gain 1.156, which is a delta of $323,000. So again, is it huge? No, it's not huge, but take into account, I mean, it is huge, $323,000. That's actually $323,000 is 10 times basically the 28.7, right, over a 30-year period, which again, it's modest growth, but it's on top of what you would have had with just 833. And it's a small number, almost $29,000 invested. So that's a big advantage, even though it may not seem like a big advantage when you add in all the intrinsic additional benefits of access to capital and protection for your family.
Well, I would just like to point out, Brandon, on that point. I mean, you're saying, oh, that's not that much more, but it's something you were doing anyway. Like you were going to do this one way or the other. So any kind of gain is better than the first scenario. And this is just one slice of the pie. This is just you utilizing the policy. You also still have the death benefit. You have the protection for your family. You have, creditor protection. This is a private asset. You're not having to jump through any hoops, or nobody's coming to check on you to check on your progress, right? All those kinds of things that don't show up on an illustration, don't show, like Joe said, life doesn't show up on a spreadsheet, but just the ease and simplicity of this whole process compared to what you were having to go through before. Maybe that doesn't have a dollar amount, but it certainly has value. So I think that's important to take into account in those when you're comparing those two approaches.
Yeah. Or add in the life happens scenarios of a renter, moves out and you had a vacancy or something of a couple of months. Well, guess what? You've got capital right there that you could use to pay the mortgage, with the commercial bank during that interim period, or fix all the expenses or what have you. Again, while it's easy to get to within 3 to 5 days and, compounding at interest.
Yeah, this example reiterates why it's called the infinite banking concept, because right here you're forcing us in a way to look at one example, and you're giving us a breakdown of this forced one example. But as soon as you, all that value that Becca was talking about, that value of access to capital over a 30-year time frame, there's no way you could put that on an illustration. There's no way you could put that on a slideshow. You can't, that's where infinite comes in. I mean, what could it look like having uninhibited access to a compounding pool of capital over 30 years? There's no telling. That's the infinite part.
And we're even making an assumption in this scenario that you can get a loan from the bank. What happened in 2008? Nobody was getting anything. I mean, it didn't matter how low the prices were. You couldn't get the money from the bank. So if you have access to your own pool of capital, I mean, there's definitely deals to be had in times when money's scarce and money's tight with traditional financing options.
And when everybody else is playing the conventional game, but you're a Brandon and you're playing at this game and they feel that crunch and there you are flush with the capital, the golden rule, he who has the gold makes the rules. That's where you go shopping, right? That's where you go shopping and you add to the portfolio.
Exactly.
So it's almost like a sick joke if you think about it this way. Like the banks, there's this interest rate and they're trying to make their profit and they're going to inch up as much as they can. Like eventually they tend to put so much strain on the economy because we're a debt-based economy. So when there's too much strain, one supposed way to fix that is to release that and drop all interest rates back down to like zero, for example. It's like, well, when that happens, the stated rate might be 2%, but to Becca's point, if the banks won't take the loan, right? If they won't give you the loan, it's not 2%, it's an infinite percent. You can't get the loan.
Yeah.
Right? In the moment where all assets are dropping is when they cut the rates. That means there's a lot of opportunities. Is exactly when they say credit restrictions, right? Everything contracts. They're like, oh, we're going to scrutinize everything and make sure every T's dot, crossed, I's dotted, and you've got to be super, super duper overqualified, over collateralized. Whereas if you just had access to capital, to Becca's point, she's shopping on clearance. She's
Yep.
scooping up, you know, dollars for pennies. She's scooping them up as quick as she can. She's buying up deals. Um, yeah, I don't know. It's very interesting if you watch the business cycle, the interest rate cycle, and how it is. It's like a sick joke. You could probably identify opportunities, but you just can't get access to money to actually capture the opportunity right in that moment. Well, the people that have the access somehow, some way, are the ones that get the best deals.
Yeah.
He who has the gold makes the rules.
And that's why it's so important. Had I understood this back in 2017 or 2018 and been able to implement this, how much more ability would I have had, today or even in the interim, to be able to access more capital to create more assets that were producing income over that period. So I said, well, that's looking at just that money out of pocket. What does it look like with doing the whole thing? So if I used my example earlier and I said I was funding a policy for maybe $50,000 a year, and so I funded it 4 years, I would have the capital. I put $200,000 in. I would have had the capital at that point to fund the entire purchase, the entire remodel, and it wouldn't have cost me those fees that the hard money loan cost me. I wouldn't have had to go through any bank deals where I'm begging them and they're looking at my credit and they're looking at everything to be able to get the loan. I would have just been able to close on this property maybe even in a couple of weeks instead of 30 to 45 days, which is a traditional closing period. So what do the numbers look like in that scenario? So cash flow after expenses. And so that means I'm taking a policy loan. The insurance company's charging me some interest, and I still have taxes and insurance on the house. And now that it's a short-term rental, there's additional things like internet and water and electric, right? So after expenses are paid, my cash flow is greater because I have the loan that I'm holding myself. So I take that and I split it into two pieces. I pay $900 a month to the policy loan. I take the rest and pay it towards policy premium. My total cash value in 30 years is 1.048 million. My total gain is 1.58 when you add the asset value itself to that number. And versus without IBC, $833,000. So we're talking about, oh, I thought maybe there was one more bullet point. So we're talking about now, I did it again, double, double the net worth in these two assets with the same money. All the while you've protected your family, you've got continual access to capital, and you just added that one step. So I'll go back and put these bullet points back up on the screen.
And since you put those back up, I'm sorry, and since you put those back up, Brandon, for people with an eye for this kind of stuff and the imagination for it, you're even using some net numbers. Now, I don't tell people what to do. I'm just bringing up this point that I see, right? That you're saying, well, this is what my cash flow would be after I pay property taxes, after I pay insurance and stuff. Can you facilitate that type of stuff as your own banker? Yes, you can actually. So you could, what I'm saying is there's more cash flow that's available that could even fund the policy greater, and you use the policy even for the things like the home insurance or the HOA or the property taxes or what, like, it's the infinite banking concept, right? So that's just what occurred to me in this more conservative approach that you're even showing. It could even be better.
And I've got more control with this scenario too. Before I had control over $29,000 of the puzzle. Now I have control over $150,000 of the puzzle. Joe?
Yeah, I wanted to add on to a little bit of what Jesse's saying. I like to say your policy could absorb more of the cash flows that are involved in this. So, unbeknownst to us, we just assume we have to pay these other people first. The beauty of like owning rentals is you get 100% of the revenue first. You choose what happens next. One of those choices could be something like this, to then turn around and then pay those things from the policy, keeping your capital scaling even faster than what he's showing. That's really cool to think about. And I think it's important to realize, like something Brendan said a little bit ago, if he would have realized before 2017, like it's one step and he had all this, but he could have started earlier. Remember his saying, pay longer or pay more. If he would have been paying longer into this policy, that changes all these numbers.
Right.
Right? The ones like the earlier you start, the easier it is to do with this, the more control you have over the whole puzzle, as Brandon was saying.
Yeah. And that 900 and that 790, those are numbers I chose. This wasn't the insurance company like a commercial bank. If they were like a commercial bank telling you this is how much the interest is, this is the period, this is your payment in a story, you're going to do it or you're not. If you don't do it, we're going to take the house away. This is me saying I'm choosing to pay $900 a month to policy loans. I'm choosing to pay $790 a month to premium. I have the control. It's an unstructured loan, and the options are all in my hands, not the bank.
One thing that sticks out to me too is you're showing us these examples and saying, once it's all paid off, once the loan's paid back, here's my gain. But I think there's one thing in here that doesn't necessarily show up without kind of digging a little bit is because of the revolving nature of policy loans and the fact that as soon as you pay that back, that money's available again. Let's say halfway through paying back that loan, you have another opportunity pop up. Well, guess what? I can take that capital and redeploy it, even though the quote unquote loan balance isn't paid off yet. And that's something that you don't have an option with traditional financing, right? You're committed to this until it's paid off, right? And then in this, you could do another one of these, maybe two more if they're in the same time frame. exercising that velocity of money to, I mean, it's pretty amazing once it gets going.
Actually, that's a beautiful point because in the early years, again, it's all about the time that Joe pointed out again, and then what you just pointed out of redeploying capital that was earned from this. Um, in the early years of doing this concept, IBC with a rental property, you're essentially making money in two places, right? Within the policy loan at a steady growth of maybe around 4%. And outside the policy loan, which by the way, the ROI on this property was like 24%, with that cash flow of $500 a month and 28,000 out of pocket, right? That's a really good ROI. So that's what I'm making outside of the policy. And so now you fast forward, like Becca just said, 10, 15 years down the road, you pull more money out, you put it in another asset. Now what? You've just added a third vehicle that's producing income. So now it's like three places. Like we're not practicing fractional reserve banking like the commercial banks in the United States practice and practically all over the world. But we've got collateral in our cash value that's given us the ability to now be the banker. And because we're the banker, we're making money in that scenario in three different assets versus just two.
I think one thing, another piece that Becca, Brandon, you had said this, but Becca's alluding to here is like the control factor. If something like if you go back to the beginning slides when he's talking about the expenses and the hard money lenders releasing money potentially and so on and so, if if it went an extra month, that throws a kind of a wrench into these numbers. If it went an extra like 3 or 4 months, that really throws a wrench into these numbers. Whereas with this setup here, with this policy loan, Brendan is in complete control and can just say, we're going to stop loan payments for this month until we get this figured out. He's in complete control. We're going to freeze payments, payment holiday until we start generating cash flow. Payment holiday because it's Brendan's birthday, so he's going to take payment. I don't know. Like he is in control, soup to nuts. He's in control. That is really, really powerful to be able to match or even drop your expenses way below your cash flow need for that period of time. Like to turn your cash outflow, the expense to zero for a set period of time so you can get your legs under you. I mean, if your hard money lender would let you do that,
Right.
right? If only the banks would let you do that. And some of them have negative amortization schedules, but there's still so many more rules and constraints that they wrap you up with that people just don't pay attention to. Like they see the carrot, I get the money. I'm just gonna jump for the money, but they ignore all this other stuff going on. Yeah, sorry, keep going.
No, here's what I got to know. That was a super valid point. Everybody needs to maybe even rewind and listen to that again. But here's what I got to know. What kind of Yankee saying is soup to nuts? Did you say soup to nuts? What is that?
Start to finish. My apology.
No, seriously, I'm going to have to Google the etymology of soup to nuts. What is that?
We're broadening our knowledge in so many different categories today.
So many.
That's good.
Yeah.
All right. Now,
Yankee.
yeah.
Hey, the Eagles are in the Super Bowl.
Yeah, y'all carry on with the conversation. I'm going to be Googling this Yankee saying.
Yeah, they always had soup, and then after they had their soup, they ate some nuts, man. That's not a tradition where you're from. Come on.
We have biscuits and gravy is what comes to my mind, sir. Biscuits and gravy.
Biscuits and gravy.
All right, we hit this already. Super cool. So here's the final, disclaimer and final slide. So it just shows the effect of giving up the interest I could have earned on the down payment, and then again I added the scenario of the entire purchase of the property versus if I placed that basis, those dollars in my private bank through the vehicle of a whole life insurance contract first, where it would grow at compounded interest for the rest of my life. And again, I've only modeled out 30 years in this illustration, and hopefully my life expectancy is still beyond that. So that's it. I appreciate you guys coming along for the ride.
Presentation, man. This was awesome. I think there's a lot of great takeaways, and man, it's a great case study for anybody involved in real estate. Um, maybe give if you have questions, I would throw him his direction. He's very knowledgeable in this space. Um, I don't know. Hopefully, Jesse's going to put your contact information in the description, in the show notes.
Love to have the conversation with anybody about it. Love to brainstorm. This is fun for me, right? It's not really just work. I do it because I really love it.
If we're reversing the logic here, though, if we take some of the nuggets we learned today, like this idea that pay longer or pay more, if you could start earlier, start earlier. If it almost begs the question, how much should you pay into this? Like it kind of leads you down that rabbit hole. And there's no right or wrong answer here. Start small if you need to, but at the extreme, if we take the logic to its extreme, it's almost like, man, how much cash flow can my policy absorb? How much do I want it to absorb so that I can have all these benefits and control everything? Most people logically would say, man, I want as much control over the process as possible, which lends itself to I want to pay as much premium as possible. Although people don't usually connect those two dots, the mechanism that gives you all of these benefits is the premium, right? The storing up capital, the mechanism that lets you do that is the premium, paying the premium. So this is, I think Brendan said it. If not, Jesse said it. This is not get rich quick. This is not a scheme. This is redirecting cash flow and collecting it and building it up somewhere that gives you the most control, the most benefits over whatever you want to finance. This is a great example for real estate, but this works in every type of business. It works for every major project.
Yeah, something that as you were talking, it made me think, and even back to Becca's scenario, buying a second asset, maybe 10 or 15 years into the deal. One of those slides I told you guys I did a cash out refinance in 2022. And for people that don't know, when you do a cash out refinance, I got $32,000. But was the IRS saying, Brandon, you got to pay taxes on that $32,000? No. And guess what? They don't say that when you do a policy loan either, as long as the policy loan stayed functioning the way it needs to function. And we all help people set up that appropriately so it doesn't happen. But you do a cash out refi or you do a policy loan, it's a non-taxable event that could be then money and capital that you could put to work for you somewhere else without paying the taxes on that basis that you're deploying.
And that's
No, absolutely. And I'll say, go ahead, Jeff.
I was just going to follow up to that like if you take this to its natural conclusion, one day way in the future, Brendan's going to pass away. And if he does all the things that you see and like cost segregation and depreciation, aggressive depreciation strategies, gets everything to zero, and then tries to sell it, which is a state would have to do, what happens to what gets recaptured? Like you postpone the tax, it didn't go away.
Mm-hmm.
Right? And if you keep doing this and have hundreds of properties or massive properties, you're well above like the estate tax like exemption.
All right.
So it's going to get hammered when it gets passed. Whereas this other thing that you have is perfectly designed to be passed to the next whoever you want, but the next generation.
Right.
So it's almost like we have it, most people have it reversed. They have this thing and they're like, oh, let me go buy an asset. And that's the point. The assets are the point. When in reality, we should be like funneling the cash flows back to this because this gets passed perfectly to the next generation. And just to be clear here, estate taxes still apply to this if you're above that level. It's income taxes that you're exempt on your life insurance death benefit. But for all intents and purposes, this is the best place to store up capital and redeploy it. So everything, whether it's if you prefer stocks instead of this, or businesses instead of this, or real estate, like the cash flow should be looping back into this as many times as you can to make this the bulk of the thing that gets passed.
Amen. Becca, final thoughts?
Well, just kind of to piggyback on what Joe was saying, I think so many times we let the tax tail wag the dog. You know, I'm doing this because I don't want to pay taxes. But as he was saying, like you're gonna have to pony up now or later, right? We're not getting out of the taxes; we are deferring them into the future. And so, I guess it comes back to the question: well, do you think tax rates are going up or down? And if you think that they're going up, well, why would you want to wait to pay them? Yes, Joe.
It's not just tax rates. A lot of
Mhm.
professionals just say
Yeah.
tax rates. They can change the tax bands. They can now, hopefully, current administration is trying to get rid of all this, but like as is, they can change the band, the thresholds. They can shrink or
Hmm.
enlarge them. They can add, remove, subtract, or limit credits, deductions, so on and so forth. Right? They have like 10 levers they
Hmm.
can do to change your tax liability. Do you think your tax liability is going up or down? I don't care what the government does in terms of all the taxes.
Yeah.
Is that number going up or down? That's what you have to decide.
Brandon, final thoughts from you. No, I can't tell you how excited I am that you made it on to the first round table. I've definitely been looking forward to it immensely, and it was fun to have a decided topic to cover that was a surprise to Joe and Becca, and you get. And I'd not seen that presentation. You told me that you wanted to talk about real estate, but I'd not seen that. That was just a lot of fun to see, to congratulate you on, to talk through the pros and the cons and the what ifs, and hopefully inspire people that, if they are considering this concept for the first time, of course, they need to be getting in that Becoming Your Own Banker book and begin the foundation. I've got a presentation on my website. And Joe, to your point, of course, I'm going to, as always, put everybody's contact information below. If you guys use a presentation or your websites, people will be able to get in touch with you to have a conversation about what this could look like for them to implement infinite banking into their household or their business or their investing or whatever it is that they're doing. But I would like to ask you, do you have any final thoughts?
Yeah, I think the big picture as I'm thinking about this right now is there's a lot of information online about real estate and about the infinite banking concept, right? And hopefully, what we've talked about and we touched on it multiple times is this is not the infinite banking concept is not a magic money machine, right? This is going back to sound money principles that it takes time, patience, diligence, discernment, right? But if you follow the tried and true path, which may be the harder path to take in some senses because we're impatient as a society, it pays off. It pays off for you, pays off for your family. So hopefully the presentation was something that was clearly not like a bunch of razzle dazzle stuff that says that you're going to make a bunch of money and it's really easy, right? It's that's the main point that I think people should take away, is that none of these two things are quick and easy. It takes work, but it does work, and I would say it's tried and true.
Fantastic. Now, see there, Joe, there's a saying that everybody knows and understands, razzle dazzle. I get it. It makes sense. And maybe this will be in the extras, we'll see. But soups to nuts is an idiom that can mean from beginning to end or to cover every aspect of something. And it says, whisks us back to traditional American and, here's the culprit, British dinners were soup for the first course and then nuts for the grand finale. So there you go. That's why I say Yankee. It goes back to your British roots, I guess, or whatever. I'm just picking at you. Guys, this has been an absolute blast for me. I can't wait for our next conversation. There's still so many things that I'd like to there still are so many things that I would like to share with y'all. As always, I'll say that if y'all have something you'd like to bring to the group, please do. For everybody that's tuning in, contact information for Brandon, Joe, Becca, it will be in the show notes below, so you can get in touch with them. You can find me at durhamtalents.com. This has been a lot of fun, talking about real estate, talking about business, talking about infinite banking. I hope that you've enjoyed it as much as we have. If you have comments or questions, you can put that in the comments section below. We'll address those on a future round table. And my hope is that you do learn to live and leave a lasting legacy. Have a great day. Take care.
You to pick somebody and then say elevate to co-host or make co-host or something like that.
Yes. Or remove. I have the power to remove you,
You
Brandon
can kick me
Bristow.
out right now.
I just got off a fantastic phone conversation with a family. So I've got a client who messaged me the other day and said, I made a presentation to my family and we want to have a family meeting call with you. And I said, well, that sounds fantastic. Let's do that. And I just got off from talking with him, current client. His wife gave a quick wave in the background on the Zoom call, did a Zoom call. And his grandma was on there. His mama was on there. His little sister was on there. We just had a fantastic conversation. So good.
That's awesome.
That's the kind of stuff that fires me up. I love talking with a person, right? Who's about this business of becoming their own banker. It's amazing. It's amazing to talk with a person. For me, there's something really special when you're talking to more than one generation.
Hey, you know what? Then I have to thank you, Jesse. There was a moment where I was like, I want to do this podcast. I don't know. I don't feel prepared. I don't know. Becca and Jeff from the group all talked me off the ledge. They're like, just do it. Just speak the truth. Look, he who has ears will hear. Just let it be what it is. Just go on there and speak the truth. We need more truth out there. So thank you for that. That's validating the idea. Just go out there and put out good content. Put out the truth.
Absolutely.
Let the chips fall where they may.
I can't tell y'all how excited I was to see y'all's faces on the thumbnails on the YouTube and be like, those are my buddies. I want to hear what they have to say. So I listened to whatever the one was that I messaged y'all about the other day. And now I've got the one about, is IBC only for high net worth individuals in my save for watch later next. That one's in my queue of things to watch next. Oh, I was so excited to see more stuff from y'all where I could watch you on YouTube and everything. So, oh yeah. I can't tell you how encouraged I was one time, Brandon. I was looking at a property. Water was cut off to this place. Electric was cut off to this place. Owner lived in another town, and I was looking at it, right? Like I'd actually made an offer on the place 4 years ago. And then they reached back out to me. Actually got to a point where they were interested to sell the place. And I'm looking at that place and I'm like, man, is there too much? Like, do I have anything to work with? Do I have enough to be able to fix this one? And and I had all different kinds of guys out. I had all different kinds of guys out. Give me this estimate. Look at this. And but one guy was the most encouraging to me when he said, Jesse, everything's fixable. And I'm just saying, like emotionally, I mean, you deal with a lot between your head when you're trying to make a deal work, right? And you're trying to figure out, how do I make this right for everybody? And it was just a good moment, right? Where like, okay, if you're dealing with a pile of ash, no, you can't fix and flip that. You know what I'm saying? Like there are limits, but him saying that was a really encouraging thing to me in that moment. Yeah, so this is a neat conversation altogether to me. So I'm ready if y'all are.
Good. I was just gonna add, I don't know if this is gonna make the podcast or not. I was gonna say that was something I used to train people with at Northwestern Mutual, like interns and co-ops and things like that. I would just tell them very few things are that we can't fix. Making the mistake and learning to fix the mistake is a really good feedback loop for you to learn the material. I know in school it's the opposite. You don't want to make mistakes, but like get your hands dirty. You'll be better for it the next time around. You'll be more efficient for it. So I love that encouragement. That's awesome.
Yeah, that's so good.